Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. More records were set in New York, except for the small caps on the Russell 2000. He takes a look at soaring lumber prices, silver, the U.S. dollar, and the upcoming Canadian federal budget. Editor of the popular blog jugglingdynamite.com, Danielle Park, also examines what could be in the Canadian budget and tells us what she thinks it should and should not contain. WolfStreet.com editor Wolf Richter reports in from San Francisco and comments on the U.S. housing boom, mortgage rates, and the skyrocketing used vehicle market. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure, Jim.
Ross, is it just crazy lumber-rama out there? What's going on? We used to say, cheap as sticks, but that wood is some expensive.
It is just going crazy. I mean, here we are up $1,000 in a year. Can you believe? I mean, I remember we used to trade lumber for under 100, and when it got over 100, it was a great short sale. I think I'm aging myself right now, but still, we got $1,290 odd a board foot right now. You've got to be kidding me. That we'll definitely be looking for replacement materials when it comes to building, and it could be just about anything at this point. I think the last that I saw, what was it? Just the difference in the last few months has cost the average home builder another extra $20,000 just just in lumber expenses, let alone everything else that's going on these days.
In the U.S., it's about $25,000 more for a new home.
Okay, all right. So pretty much as I'd heard. We've got, on the first run that we had a year ago into June, we got some really overbought signals and a nice solid correction into the summer. And, even this big run of the last couple of months is only just now starting to show some overbought signals on the daily charts, but the weekly and monthlies are nothing like we saw a year ago. So there's still running room in this stuff right now. So and you see it over in the home builders and in any of the suppliers, the Home Depots, the Lowe's. This thing is still just on fire right now. Which always begets the question, how far, and you never know. But when it does lose momentum, you don't want to stick around these things for too long, because it's the more euphoric the move is, the more violent the reaction is afterwards. So if you're enjoying the run, people, just make sure when it does roll over that you manage to take some profits before it becomes a negative trade for you.
Now, the markets, they always seem to be setting record highs during the week. Same story this week?
Same story this week. Here we are, 16th of April, middle of the month, which historically you're into the earnings season right now, and stocks tend to get bid up ahead of their earnings announcements in general. And in particular, in when you're getting earnings out of the first quarter, as we're now seeing reported, the first half of April, which is the second strongest month of the year, typically sees the best strength in the first half, and then the market tends to just ease its way higher after that. And as we know, the old adage was to sell in May and go away. At this point, the way that the S&P has been running consistently, if it were to continue at this pace for another week to 10 days, I can get some very good sell signals. There's nothing there as of yet. We had the small caps, the Russell, had been outperforming from August right through until early February, and now, and that was against the S&P and against the NASDAQ, the technology stocks. But technology in this last 6 weeks has really come back to life again. The XLK is just screaming along at new highs. But the Russell, and this is important here, I think, to note, that the Russell 2000 has not managed to do very well here in this last couple of weeks, while everything else has been moving up strongly. And in particular, even this week, as everything was good, the Russell's just sitting back here. And this kind of divergence can be a setup for one of those just classic 5 to 10% reactions to the downside, and about half of the reactions historically are well over 10%. So if there's any kind of a price flip on the strong indices, I would be looking at potential short sales over on the Russell. The IWM has puts on it. The RWM is the inverse to that index. And as we move through the second half of April into May, that's something that you might want to take a look at.
The Canadian budget is on Monday. Anything fearful or joyful to look forward to?
Well, I guess there's just a big question is how many billions of dollars are they going to come up with as the new deficit number here? If they can keep it under 100, that would be important. If they could keep it around 30, that would be a great number. Let the economy, come to life on its own without having the government try and, buoy it up and tell us where the money should be spent. Clearly, the government's the last thing you want trying to work for you right now. So let's hopefully get past this third phase of COVID and get these vaccinations well distributed, and maybe the market will have some life. Canadian dollar has, we've got next week also the Bank of Canada come up with its next rate decision, and if they start to raise rates relative to the U.S., that probably is supportive of the dollar. I don't really see too much right now for the Canadian. It's been pretty much sideways for maybe 6 weeks or so, just sitting around the 80-cent level right now. And that's been with reasonably buoyant commodities. Most of the commodities are back up around their highs again. Lumber prices we talked about. The grains have been really strong. You've got copper price in that $4 to $4.15 range, holding in there pretty well. So Canada's been lucky. The other currency is the U.S. dollar. Now, the dollar double bottomed right around the end of the year at 89 on the index, and then had a good run up to 93 at the end of March. And during that, we ended up getting up into some pretty good areas to look at selling, which was part of why the Canadian bottomed out. And the U.S. dollar is now backed off enough. We're back at about 91.5. And it's corrected enough that we're into one of our support channels that we look at. We've got the sequential signal kicked in on Friday, so we're probably looking at this becoming an interim low for the U.S. dollar, and I think you're going to end up seeing that come back to life again. And the other side of the coin with that is the precious metals. And this has been a great stretch for us on precious metals. We kicked in the buy signal down under 1,700 in the 1680s on gold, and had a target which was literally met right to the dollar as of today at 1783, a 38% retracement from the January high. And the modeling that we've got, this is exactly what we were looking for. We got overbought signals on both the relative strength index and on the commodity channel index. And we've got silver recovered 50% of its losses from February. That was around 26. Might see a bit more of a spike up in silver. It tends to surprise people right at the tail end of a move. Because if we measure from that, what I'll call the Reddit or the Wall Street Bets group attempt to squeeze the silver market back in January, if we measure 50% from there, you might see a $27 print in silver, but I wouldn't bank on that one.
Ross, thank you so much for chatting with us.
Always nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Danielle Park, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to This Week in Money.
Hey, Jim. How are you?
I'm doing great. Yourself?
Fine. I mean, in this surreal time that we're in, I can't complain.
We're both lucky that working at home isn't too much of a burden as it is for some folks.
Yes, for sure.
Danielle, on Monday, the 19th of April, Canada's federal government is going to be presenting its budget for the first time in over 2 years. What do you expect to see? And is there anything shocking that might show up?
Well, I expect to see more spending. They don't have much of a choice at this point. We've got, 15% of the Canadian population just with one vaccine so far. We're way behind in terms of the United States or the UK or other comparables like that, and our economy continuing to suffer from, revolving shutdowns. Right now in Ontario, we have, again, a full-on shutdown of everything that's not completely essential. And, of course, we have all these variants wreaking havoc all over. The contamination rates in places like India have doubled from their March high. We've just got a lot of viral activity still going on in the economy, and that's creating all sorts of problems. So I expect that they're going to continue this support for household incomes, for businesses, and for rents. I don't see that they have much choice at this particular juncture. We need to keep people fed and housed. We need to keep businesses somehow, at least extended a little further in case that's long enough to get them back open again. So I think that the emergency funding will continue for sure. I think that the other focus, though, that has to be included there is on the next growth and productivity enhancing activities that we can do for the country as a whole. Because really the only thing that's carried us through since the virus hit in the first quarter of 2020 has been this national mania around residential housing. And, of course, investment there has spiked to about 35% of all the money that's going in terms of an investment in Canada has been going into residential housing. That's a very inefficient allocation of resources. In the meantime, we've had a declining investment in things that will actually help us in the longer run, like machinery, equipment, intellectual property, that kind of thing. So that's now dropped to below 30%, something like 28% was the recent figure from 2020 in terms of investment. So the housing mania has really been off the charts, and it has driven a good deal of GDP growth for sure in the last year. And the problem there being, just like the spending on the emergency supports to keep people fed and housed in the short run is all well and good, but it's not helping us in terms of recalibrating the economy for the 21st century. It's not helping us longer term in terms of producing new revenue streams that can help us repay the debt that all the households, businesses, and governments have taken on during this period. And so I think that they're going to, I don't expect them to really announce any new tax hikes. I think that they will be doing that, but probably not yet. I do think they're going to allocate more resources towards tax avoidance and prosecution of tax avoiders, which they certainly have needed to do for years. That's been a blatant issue for so long. Canada's been world famous for its lax prosecution of tax avoiders. And of course now with all the holes in the buckets, we really do need to block those holes and try and get more revenue in. So that, I think, will be an obvious place. That the international digital company stuff is a pretty hot theme in the world right now in terms of other countries, including Janet Yellen, the head of the Treasury in the U.S., recently proposing a minimum global tax, and that I think it's quite likely the federal government here will follow the trend in the world right now, which is to suggest that these international digital companies will have to remit federal sales tax. That seems like a no-brainer to me. Clearly another obvious way to get some cash flow in, and they've really been having a tax-free holiday for far too long already, which is part of why we got into the massive deficits even before the pandemic hit. So the corporate tax rate certainly has to go up, and I think that the low-hanging fruit is the large digital companies and the multinationals that have actually done really well through this period because they have had the global reach and ability to access capital markets and to benefit from the layoffs and, of course, automation, all these things that are helping the larger companies to make profits even in the challenging conditions. Anyway, I think that's an obvious focus of policy. I also think we're going to see, more talk of the vacant property tax stuff. We've talked about that before. There's a lot of foreign speculation still going on in real estate in Canada, and it's becoming increasingly intolerable when average households and young households are just not able to form and get in on the property ladder, so to speak, because of the exorbitant prices that we're facing right now. So I think those are all the obvious spots where they should have announcements in the latest budget.
Now, if you were allowed to go out and buy some new shoes and be Canada's finance minister, what would your budget look like?
Well, I would be looking at the fundamentals that will improve our productivity as a nation. So that means investing in things like revitalizing our infrastructure, making us more energy efficient, home energy retrofits, investing in our population in terms of retraining, desperately needed, in terms of job opportunities for young people. We have to get the next generation of people up and out. Right now, there's a whole bunch of 20 to 30-somethings that are living with their parents, not by choice, but because they either, have lost jobs or have lost opportunities in the last decade, and that's been really made worse by the pandemic shutdowns. On top of that, housing has become unaffordable. So they've had stagnant wages, poor opportunities, and they can't form houses. This is, ultimately all of our problem because we have stagnant population growth. And you see the federal government announcing initiatives to try and make, targets for immigration and to convert permanent students into permanent residents and all that sort of stuff in terms of international students. Because we have this very poor, very low birth rate, not replacing ourselves, and we have very poor household formation, many of the factors that I've already mentioned are behind that. So we really need to focus on not just how do we help the old folks, which is, of course, part of the society that needs addressing, but we do have to focus on who's coming up next and how they're going to get on their feet financially, because those are the taxpayers the workforce of the future, of course. So I would want to focus on things like the national child care. I think that's a no-brainer. We have to help families. We have find ways to raise children in a healthy, happy environment, and also both work if the two heads of households want to do that or need to do that for their finances. I think that's an investment. That's a no-brainer. We should definitely focus on that. And just retooling, essentially. It's, we've really, even before the pandemic, even before the trials of the last 5 years, let's say, we have not been investing in Canada for the 21st century. We've been on this antiquated model for a long time of, how do we double down on petrochemicals? And ultimately, every report, including the industry itself, including all the major oil companies, all see that is looking in the rearview mirror, and that is not the future. So we have to follow blueprints that will help us evolve into this new world economy and the products and services that are going to be in demand there. So that's where a lot of the money has to go, because, piling on the debt, that's been one thing. Some of it essential, as I say, a lot of it not essential, but because we've become preoccupied with self-destruction and overbidding for housing, none of that's going to help us, and none of that is going to help us pay back what we've borrowed. So we really have to focus on the next stage and how we're going to get there.
Are the ongoing lockdowns destroying Canada's economy?
Well, I think they're, destroying all sorts of things. We certainly know that it's enabled consolidation in large public companies, because in many cases the big box stuff has been allowed to stay open. That's a trend that's not helped us, because that was already too much concentration in a handful of the larger companies, which have been siphoning, jobs and capital and income out of the communities, the local communities, for a long time, and leaving, everything going to the mothership of the international investors, so to speak. And that has really been a deficit in domestic economies for a long time. But now we've got this 1 in 6 small businesses, either already closed or not likely to make it through the next 6 months. But, in terms of handing out blame for this, I really do hesitate to point to any particular official. I think that's a bit of an immature response. On the other hand, there are certain people that have to actually make these calls. The governments are looking to the medical officers to say, what do we need to do to try and contain this catastrophe, really, that's been happening all across the world, and how do we stop it? Because if we can't ever stop, we can't ever get fully into the recovery phase. This fits and starts, stop and start, all of this is just going to keep going for a long time until we can, finally get through it. So it's a very difficult solution, because obviously when we've had various stages of reopening, that's when the virus begins to take off like a grass fire again. And so, yes, I think it's done a lot of devastation, but I really don't know what the alternatives are. And I think if there are better alternatives, people have tried various approaches, and every time everything kind of goes back to as if things are normal, we get this next resurgence. And unless you're on the front line in the ICU working, day and night like so many people are, I really don't think that it's up to us to decide whether, whether it's necessary to have these shutdowns. Apparently it is, to at least stem the flow of people coming into the hospitals. So it's a really difficult time. I have lots of empathy for all sorts of people and businesses, but at the same time, I don't think it's fair to say the lockdowns are destroying the economy. I think we're dealing with, a massive pandemic, which is actually what's been causing the havoc in the economy.
Due to COVID-19, Canada's federal deficit and debt have ballooned. Should we care if governments and deficits continue to grow?
Well, we're certainly not alone in that, right? Global non-financial debt reached something like 280% of GDP in 2020. It jumped 37% in 1 year, and it's increased since then. So this is like a secular surge in debt that we haven't seen, really. It's unprecedented. But we do know that large leaps in debt in the past have been always followed by disinflationary, deflationary periods in history. And so historically, when you add this much government debt, you get a negative multiplier. At any time that gross debt has, a lot of studies have been done, but any time that gross government debt is about 40 or 50% of GDP or above, it's really a negative. So you get some short-term bang for the spending, but then all long-term it diverts more capital away from, productive activities in the economy, and it inevitably ends up in higher tax collection, right? That's ultimately what has to happen, and more debt issuance, but there's a limit, right? So yes, I think that Canada's, debt has leapt. Now, there's been some revisions. The IMF did a study that was predicting, originally they said Canada's combined government deficits were going to be something like almost 20% of our GDP. I think that was last November, and in their recent report this month, they've reduced that expectation to just over 10.7%. So that would be about smaller than the G20 average, which is about 12.7% of debt to GDP increase here. Deficits, the deficit. So that suggests that Canada is, certainly adding on, running into the red, but they're not alone in that. And again, it's, the modern monetary theory is the one that's sort of prevailing right now. And ultimately, if you look at what happened in the financial crisis of 2008, banks were bailed out by central bank flows backed by taxpayers and debt issued by governments, right? And they then went on to lend their brains out and lever up and do all sorts of reckless activities again. And then when you hit the pandemic in 2020, it really blows up. It blows up capital markets, which are highly levered and speculative at that point. It blows up households, which were too indebted and undersaved, and it blew up businesses, which also had very little side away for rainy days. And in terms of small and middle-sized businesses, they were already at the highest debt levels in many years. So what happens is now you've got governments forced to come up with emergency funding, and ultimately central banks helping them to float debt and continue to circulate it and try and suppress interest rates in the near term. And now the thesis is that it doesn't matter that governments have so much debt because they can be bailed out by endless amounts of money printing. And that's certainly the direction that the world has gone in the last year. The caveat I would have there is that inherent in that thesis is the necessity for taxation to act as a release valve, if you will, so that when there's too much capital backing up in certain sectors of the economy, that tax is meant to be increased in those sectors in order to release the speculation and excess capital back towards the government coffers. So that is sort of like a dam that the tax is supposed to perform that function. So I would just say that, again, although we may not see tax hikes in the budget next week at this interim stage, they're definitely coming. And I think that the corporate sector in particular has got away with, the large corporate sector, as I mentioned earlier, publicly traded companies have been paying the least tax in many, many decades, having had rates cut since, the 1980s. And so I think that we're going to see that come back in as part of the draining of excess capital out of that sector and needing to direct it back into some of these others.
We'll have more with Danielle Park right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Danielle Park. Danielle, are people using their homes as ATMs?
Well, Absolutely. That's definitely a trend we've seen since the pandemic started, where people have, been stuck at home and access to free credit and even some free income from the government, and they've definitely turned to making their home more user-friendly or, all-encompassing, whether that means putting in a gym or a pool or a garage or whatever else they needed to enhance their experience of being at home. So yes, that's gone on. Household debt to income in Canada was just under 170% in 2020. That's actually down a little bit from the peak of something like 176 about a year earlier. But that's really, if you think about it, to disposable income. The reason that the number came down is not because household debt came down, but because disposable income was increased by subsidies from the government. So, we've gone in the wrong direction in terms of building up cash reserves. We've really doubled down on this whole, as I say, the non-productive allocation to houses, which in the end, has the overall economy's become unduly dependent on that chain trend, which is not sustainable. And also it's made much less savings for other opportunities like retirement, for example. Most people have all of their resources now allocated to just trying to keep a roof over their head, have much less available money to save for things like education, which is another key important thing to enhance productivity of a family and of a nation longer term. So the siphoning out of capital, we saw similar patterns, of course, in the 2006 bubble in the United States, where the U.S. housing bubble that The Big Short was so famously written and the movie was done about. But residential investment in Canada reached 9.3% of Canadian GDP in the third quarter of 2020. I think it's got worse since. The all-time peak in the 2006 housing bubble, by the way, was about 30% less than that, at 6.7%. So we've got a lot of issues here. The other thing is that even if interest rates stay low, I actually think the weight of all this debt will come back to keep inflation and interest rates suppressed for a considerable period of time. The problem is not that. The problem is that we still don't have, a good case for sustained wage gains. And so back to the point here, if you've only added more debt, even at record low interest rates, half of the mortgages in Canada have apparently been locked in, are about locked in in sort of 5-year terms and less, but not floating. And many of those mortgages, a lot of them have been taken out at less than 2% in the past year. So that is one thing in terms of, sustainability perhaps in the short run. Your interest component has come down, but let's not forget the payment is also comprised of the principal component. And so when you're paying back a house that in, for example, areas like where I live have doubled in the last 5 years, let's not kid ourselves that you're getting away with a cheaper housing cost just because your interest component has gone down. Ultimately, you're paying twice as much for that shelter, and you will be continuing to pay that for decades longer because it's gone up in price so much. The other little factor I think that's important here is that economically, when you've had a recession, you tend to see the fallout continue for multiple quarters thereafter. So even if the recession of 2020, has ended, and that's arguable that it has, but you could also see a double dip recession similar to what we saw in the 1980 and 82 period, where you have another relapse into weak growth. And I think that that's quite possible because we haven't seen the bankruptcies typically that follow from recessions yet because of all the government support that's happened. Historically, you get bankruptcies peaking 18 to 24 months after the end of a recession. So we've still got a lot of that yet to come. The same thing with the low in inflation and the low in interest rates tends to come several quarters after the end of the recession as well. So although we've had this inflationary period for all the reasons that I've spoken of, the obsession with buying things on credit, the free money handed out left and right, and you've had this big resurgence off low base effects from 2020 when everything was just basically shut down for the first quarter, you've had this big resurgence. But I think that the follow-through here is going to be a lot more muted. And there's not likely to be the sustained recovery from current levels that people have priced in. That on top of the fact that asset markets in terms of the stock market is back at delirium highs. So when you get delirium in all these asset classes and everybody highly levered and an economy that is still below where it was in 2019, or jobs are still below where they were in 2019, you really have a very challenging environment. And so I am worried about the people who have spent too much, borrowed too much again in this period. And there is not an endless amount of support and bailouts that can be offered for all these sectors all at once.
Going forward, do you think the focus should be on the economy or the environment?
It's not an or. That's really not the question at all. To think that we can have an unsustainable environment and call that somehow smart for business is ludicrous. Of course, everything has to be longer term sustainable, or it's just borrowing from the future and spending it in the present, or consuming resources in a reckless fashion and not worrying about the overhang that comes. I think the brilliant opportunity, the timing of all this has really lined up where we have technology advances that will enable us to do things like reduce our consumption of energy by 63%. Of course, that's something we should be investing in. And of course, that would be better for emissions, for air pollution, for spending at the household level. There's so many things that we can do here with the technology that is available that it would be highly stimulative. Biotech, there's another one. We've seen the devastation of pandemics and the problems with, creating vaccines and doing all this support in foreign countries. Of course, there's an area where we could do investment in the domestic economy that would make us more resilient. It would create a whole bunch of jobs. It would drive GDP. There's a lot of things that make sense on both an environmental and an economic level, and we need to be doing those things, not the things that choose one over the other.
Conservative leader Aaron O'Toole has released a climate platform statement that puts a $20 per ton carbon charge on fuel. He says it's not a tax, it's just a carbon price. So even the Conservatives are looking at this, so it's not party exclusive now in Canada. I think all the parties except maybe the Bloc Québécois, and I'm not sure what their policies are because I don't speak French. But they're all talking about some kind of carbon pricing. Is that the wave of the future?
Yeah, but $20 is ridiculous. I mean, it's supposed to be more like $160. So anyway, but that's a start. It's been obvious for more than a decade that we need to have pricing on carbon. We need to tax the things we want less of, and we need to incent the things we want more of, right? So it's clearly part of the structure. And again, enormous opportunity here in revamping this entire system. Lots of retrofitting, lots of training, lots of jobs, lots of opportunity for saving and not wasting, lots of things that we can do. And yes, that's part of it.
Mm-hmm. Does Canada have some natural advantages here coming out of a worldwide recession that perhaps other countries don't have?
Well, we have an excellent workforce and people. We have, generally higher health, generally higher health care, generally higher education than average. But what we're lacking is some, as I say, investment, business investment, technological investment. We keep having a brain drain where we lose our most talented people, seduced to other countries because we don't have that much industry, modern industry for the 21st century still going on in this country. So again, we need to be a lot smarter in the allocation choices that we're making. We need to have the political process, revamped so that we don't just have this stranglehold of the legacy industries that are trying to drive the policies. We need to have a lot more interaction with the companies and the people and the leaders that see the future and where we need to be headed.
There's talk of a international minimum tax on corporations. Is that something that's good or bad?
Well, that's something that, as I mentioned in the beginning, is essential. And again, this is just tax policy catching up with the 21st century. We've got this surge in multinational corporations that's been going on for decades. They've been evading more and more tax over time as they've taken a larger share of the income pie. That deficit of income that they've taken has been left in the coffers of households, workers, and governments. So now we need to have some righting of that imbalance, and that means that, for a long time they were able to dodge tax by being attracted to low tax havens like Ireland, the south of Ireland as an example, many other countries. It was this race to the bottom, who can get companies to come there while giving them the most and expecting the least. We've really run to the end of that, and now it's essential to come up with some kind of a global tax so that we can stop this sort of dodging from one country to another and get them paying things into the pot, because let's face it, large corporations are greatly benefited by the infrastructure that's provided on a local basis in the countries in which they work. So they need to have a connection of paying tax where their customers are, where their workers are, where they get all the benefit, where they get all the revenue. And that's what's been sadly missing for the past many decades.
Danielle, before we go, can you just give us a little snapshot of Venable Park Investment Counsel Incorporated?
Yeah, we're a absolute return pension management style for individuals with households wealth of $1 million or more, and we've been in business since 2003, and our whole focus is on helping individuals navigate secular and cycles where they don't lose money over time, and they're able to prosper and benefit throughout.
Danielle, thank you so much for being on This Week in Money.
Thank you.
My guest has been Danielle Park, editor of the very popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Coming up, Wolf Richter next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Welcome back to the show, Wolf.
Thanks for having me back, Jim.
Wolf, the housing market in the U.S. has obviously been booming in recent months, and we keep seeing these comments about the shortage of inventory for sale. What do you see going on there?
That's an incredibly fascinating market right now because it is completely screwed up. And we have seen, now in the media, you see all these clickbait stories about bidding wars, ridiculous bidding wars that lead to ludicrous amounts over asking that were being paid. And there's one every now and then around the country that then gets pasted everywhere. And you have some of that. On the other hand, we have seen now for several months in a row now a decline in demand. So pending sales have come down a whole lot. Closed sales have come down a whole lot. We now see mortgage applications the latest week fell actually below the 2019 level of the same time in April for the first time in this boom. So the demand has been weakening from retail buyers that buy homes, and so that's mortgage applications, and then also just in general we see that through closed sales. There's all this discussion about the shortage of inventory, but when you think about it, the United States didn't grow by 10 million people all of a sudden during this past year. There was a population growth that we don't really know yet, but it was the lowest probably in many, many decades, because number one, we slowed down the influx from other countries. Number two, the birth rates fell. Number three, we had over 500,000 excess deaths due to COVID. So, there just hasn't been any major population growth and household formation in the United States. So that in theory, there cannot be a housing shortage, that cropped up suddenly. What we do have, though, is, homes that are vacant and are not on the market. And we also have, companies buying homes to then rent them out. So we have those two big factors. And when you think about the math, when you buy a home and now home prices are surging, and they were surging in the last few months, and people look back at those and they think, okay, if I hold this home another year, I'm going to make 10% on it. And so they buy a new home without putting the old home on the market. The old home, they might, it might be $500,000. They might have 20% equity in it. So $100,000 is their own money. If that $500,000 home increases by 10% in value, they're making $50,000 on the, 50% return on their equity. They make $50,000 just holding the home for a year. And this is now happening all across the country. The people that are buying a home are not putting their old home on the market. So, this has put a serious constraint on supply. Because normally, when you buy a new home and you sell the old home, and a lot of times you buy the new home and you have a contingent contract that you have to sell the old home, and the lenders are insisting on some of these things. And none of that matters. You just buy a new home, finance it, and you still have the mortgage on the old home, and it's fine. It flies. And we have seen that now in the data. So mortgage applications for second homes, these so-called second homes, have doubled in February compared to a year ago. They're now a much larger portion of the total mortgages. We hear anecdotally from appraisers all the time that they're consistently appraising vacant homes. People that have left and they need an appraisal, and they still own the home. That nobody's living in it. They're not putting it on the market. Those kinds of things. They're refinancing vacant homes now. So we have this inventory shortage because people are not putting their old homes that they have left on the market. They've bought new homes, but they're not putting the old homes on the market. Now, this is really shadow inventory. This is waiting in the shadows to be put on the market when it's convenient for the homeowners to do that, and it becomes very convenient suddenly when home prices stop rising. Because carrying a house, that's pretty expensive. You have to pay taxes on it and utilities and other things, and there's a possibility that something goes wrong. So unless you see hefty home price increases, you're not going to hold it. So if those price increases slow down, you're going to try to sell the home. And obviously you're not going to be the only one, because now we've got all this massive shadow inventory, and then there'll be a lot of people trying to sell those homes. But this is what now I've seen as the primary reason behind the inventory shortage. And again, this housing market is just completely screwed up. This plunge in mortgage rates last year caused all kinds of crazy behavior. We've also seen this trend from big cities out into other areas. So big cities have seen that shift. Now, in big cities, people haven't sold their homes yet. They haven't gone on the market. They've left. They've moved to other areas. They've bought homes there, but their homes in the big cities are still their homes, so this looks like starting to return towards some kind of normal activity in terms of what we see in pending sales and mortgage applications. And when demand slows down and the price pressures back off, probably we'll see some of those vacant homes show up on the market, and then we'll have to deal with those. Now, mortgage rates have come up in the United States quite a bit, roughly from 2.7%, 2.8% to now at 3.3% roughly, 3.25%, that range for a 30-year fixed rate mortgage, which is our standard mortgage here in the United States. And for you Canadians, a 30-year fixed rate is not really an option if you have, but this is the standard mortgage, and it really means a fixed rate locked in for 30 years. with principal payments spread out over the 30 years, so the mortgage is amortized to zero over the 30 years, and then it's paid off. These rates are generally backed by the government, and that's why they're even possible, because private lenders without government backing would be very leery lending for 30 years on a home. So that's our benchmark mortgage, and those rates have come up from around 2.7, 2.8 to about 3.3 roughly, and that has dented demand. In addition to the soaring prices, I mean, that is clear. The prices have jumped, mortgage rates have gone up. Also, maybe that initial demand has been faded. So now we see a sharp decline in demand, and I expect that inventory shortage to just sort of suddenly disappear when all these vacant homes that have been left behind are starting to be put on the market.
As long as the Fed continues to print money, are we likely to end up with higher and higher home prices?
So that's the speculation, but what we've seen is that home prices are very dependent on mortgage rates, and the Fed has kept short-term rates at zero, but it has allowed long-term mortgage rates to drift and long-term interest rates to drift, and they have gone up quite a bit, and so mortgage rates have gone up quite a bit. So that's going to put a damper on demand, and we've seen that decline already in demand for housing. When the shadow inventory shows up on the market, and interest rates are rising, and demand still relatively low, I think there are going to be some barriers to further price increases, and I think the Fed is comfortable with that, and in fact, it's encouraging higher long-term rates. It seems in order to tamp down a little bit on this housing craziness that we've got, and it seems to very slowly work its way into the system. There's just an affordability issue that can't be bridged. Investors can buy lots of homes and leave them vacant. They can do that. They can also try to put them on the market as rental homes. Now, rental home market is really strong, but rents don't jump up that much. Rents are dependent on salaries and wages, and so rents are very sticky. You can't just make them jump year after year by 10%. At some point, they can jump 10% in 1 year, and then they'll hit resistance. And so I think in the housing market we'll see some resistance to further price increases, even if the Fed continues with its policies. Of course, now they're already talking about tapering the bond purchases, so that's already being discussed now publicly, how to do it, when to do it, and after they taper the bond purchases means further upward pressure on long-term interest rates. They'll talk about raising short-term interest rates. So that's already on the table being discussed, and the zero interest rate and QE for the Fed is not something that will last forever. And it didn't last forever last time either. And they ended up actually, not only tapering, but actually reducing the balance sheet and raising interest rates until markets started to swoon, and then they started backing off.
With lockdowns and face masking in place, are places that are fully open likely to see home prices rise?
Well, in last year, we didn't really see any difference. Home prices soared in places that were locked down, and they soared in places that weren't locked down. Face masks have no impact on home prices, and in fact, when you have an outbreak of COVID that's really serious, that might put a bigger damper on activity than if you don't. People are more likely to leave that particular place when you have an outbreak and go somewhere else. But we just across the country, we just have not seen any connection between home prices and lockdowns, and especially face masks. The activity was, the housing activity was really strong in California. in some cities like San Francisco, the market weakened, but because people left and rents came down, but then outside of San Francisco, just an hour away by car, markets exploded. The same rules on, the same lockdowns, the same masking rules, same everything. It's just people made the move and bought homes, and so I don't think there's any connection between them.
Can you give us an update on the used car market?
Yeah, this is a phenomenon that I have never seen before. Now, I was in the car business for a long time, and used car prices have skyrocketed, and they've skyrocketed on the wholesale side, and they're skyrocketed on the retail side. And this comes in an environment when inflation is still fairly benign. It started last year. This price increase started last summer, and on the wholesale market, we're talking 20% higher prices. Retail, we got in terms of the inflation measure, we're looking at 10% year-over-year higher prices per our CPI measures. In reality, it might be quite a bit higher than that. Used trucks, particularly on the wholesale side, they're now going through 30 and 40% higher than a year ago. They're through the auction. The vast wholesale market is done in auctions around the country, and so we have very good liquid data on that. And even much hated compact cars and medium-sized cars, hardly anybody's buying. They had big, massive price increases, and used car sales volume really is at levels slightly below where they'd been in 2019. So it's not that there's this spike in demand that suddenly causes this. There are some supply issues that we're now facing in the used car market. The biggest supplier to the used car market of the late model vehicles, so the 2-year-old vehicles, 3-year-old vehicles, are the rental car companies. And the rental car companies essentially collapsed last year. 2 of them went filed for bankruptcy, Hertz and Advantage, and they all tried to shed their inventories last year, and one way of doing that is by canceling the orders and not ordering any new vehicles. And that's 2 to 3 million vehicles a year, and suddenly that order stream has collapsed, and they're not getting in these new vehicles. Manufacturers are not building them for the rental car companies. The rental car companies are not taking them, and they're not getting rid of their old vehicles. They're running the old vehicles or sitting on them. So now we've got this slowdown in supply into the used vehicle market, and that started a little while ago, and that causes some pressures. That suddenly that flow has been interrupted, that inflow has been interrupted, and at the same time we don't have a spike in demand. So it's really psychological too. Customers are paying these higher prices. They're not going on buyer's strike. So the retail customer is now willing to pay these higher prices, and dealers at the auction are willing to pay the higher prices. Dealers are in the business of buying and selling. So they know they have to pass on these higher prices to the retail customers. And the mindset has changed. Before, a year ago, 2 years ago, if the prices had jumped that far, retail customers would have balked. They would have said, no, I'm not buying. I'm going to wait. And most people can wait. Most people don't need a car right this minute. They have a car. They can drive it a little longer if they want to. And they've done that in the financial crisis when car sales suddenly collapsed because people went on a buyer's strike. And they could do that now. People could go on a buyer's strike and bring those prices down. But that's not happening. They're buying. They're paying those prices. And that's a mindset we really haven't seen. So the dealers are now bragging about record gross profit margins on new and used vehicles. And despite the higher prices that they're paying for these vehicles. So you're looking at a very inflationary scenario, and the mindset has changed. These price increases are accepted now by the public, and I don't know when that will stop, but this is the new reality that we're now looking at. That people are actually paying these substantially higher prices. It's quite amazing for me to see that.
How bad a time is it to buy a new or used vehicle?
It's a terrible time. It's the worst time in my lifetime to buy a used vehicle. I've never seen anything like this. Of course, it could be even a worse time 6 months from now. Who knows? But if this mindset continues, but I've never seen a price spike like that. People are, according to every measure, people are overpaying for their vehicles, and dealers are overpaying wholesale for their vehicles now compared to the sales data we had in prior months. But it's happening. They're doing it, and they're paying. Especially if you buy a used truck, I mean, it's just incredible what they're paying for these used vehicles, but it's happening. And so, I wouldn't buy a used car under these conditions, like I wouldn't buy a house now. I mean, if you go into a bidding war, you're not coming out ahead by winning a bidding war. And the same in the used car market. If you had an arm and a leg for a truck, I mean, I would just keep driving what I have for now.
What about new vehicles? What's hot? What's not?
Well, trucks are hot and SUVs are hot, but trucks are incredibly hot. Now we've got some manufacturing issues. And you got to remember, trucks are a luxury product essentially now. The prices have surged on them. They've got very fancy packages that sell for close to $100,000 now. And even though, like on the Ford F-150, you can get a base version that's in the $30,000 range, $35,000 range. But, once you start tricking it up and you put four-wheel drive on it, and you put the engine packages and other things on it, you're looking at $70,000, $80,000 easy. And if you try hard, you get close to $100,000. So, those are luxury products. Those are the people who have benefited from the Fed's asset price inflation. So they're sitting on stock gains and other things, and they spent some of this money on these high dollar trucks. Total vehicle sales, new vehicle sales in the United States still track below 2019. So we don't have this massive surge in demand, but we have a big surge at the high end, and meaning expensive trucks and SUVs, and they're selling really well. There's shortage of supply. Now we've got manufacturing problems with a semiconductor shortage. So some of the Ford and GM and Toyota, they've cut their production of their trucks and cars too, obviously. But there's the problem is with trucks, and so that's what's hot. That's what's selling. That's what's expensive. And automakers are making a ton of money on these vehicles. That's why they're pushing them, because the profit margin is gigantic on these vehicles. And so that's where the market is right now. The high end is what's selling.
Now, when I was in high school back in the 70s, the cheapest vehicle you could buy was a pickup truck. How come that changed?
Yeah, so when I was in the business, that was in the 1980s, 1990s, I was in truck country, so in Oklahoma and Texas, the same thing. Pickups in that part of the country were always the most popular vehicle, and you could always sell them for a good price. And but at that time, they were still cheaper than cars. And so, for example, I have an index, a price index I track, and I've constructed going back to the 1980s that compares the Ford F-150 XLT price to the Toyota Camry price. And the Camry used to be, in the 80s, used to be more expensive than the F-150. So that's a F-150 XLT. And that has completely changed. Now the F-150 is far more expensive than the Camry, and it's become a luxury product. Well, the Camry is fighting it out in a very unpopular car segment, and Americans just have not resisted price increases on trucks. Trucks are big. They're not necessarily more expensive to build because you don't have to worry about weight and those kinds of things. There's some manufacturing processes that are easier to do on trucks, and so it's not that they're more expensive to build, but Americans are willing to pay more for them because it's a bigger piece of equipment. They feel good about it, and and that's been the case. And so when these price increases started showing up, there was not really any consumer resistance to them. And, this F-150 prices have just, you look at my chart, it's just amazing what happened to them. And that goes across all pickups. And it's not just Fords, it's GMs and Toyotas as well. So, and SUVs too. SUVs have benefited from that. And, so there's just an acceptance among consumers that for a bigger piece of equipment here, it's okay to pay a lot more.
Are interest rates the elephant in the room?
Yeah. If they stay where they are, 0% on the front end and for the 10-year treasury right now, 1.65% roughly, they're not obviously a big issue. They've already left, the higher interest rates, a footprint on the housing market. We're starting to see that, as I mentioned. When they rise further, long-term rates, they will have an impact when the Fed is tapering and ending its bond purchases, those long-term rates will go up. I mean, that's what QE does. It brings down long-term interest rates and so they've risen despite QE. So when the Fed stops QE, those long-term rates will rise. And, that's a factor that, is going to be built into the economy. You're going to have higher long-term interest rates, higher mortgage rates, higher bond yields. I mean, it's more expensive for companies to borrow. It's more expensive for consumers to borrow. It'll get a little more expensive for the government to borrow. And, bondholders that have bought bonds at current price levels or last year, they're already seeing big losses. And those are going to spread. So, I think interest rates are going to be a key issue. I cannot imagine that long-term interest rates will go down. It's just right now everything is set up for long-term interest rates to go up. And when the Fed raises short-term interest rates, we'll see the shorter end go up too. So, I think that's a huge factor that the economy has to deal with.
The Fed has said it wants to keep interest rates low, but of course the international bond market is much bigger than the Fed. Who's really calling the shots here?
Well, so the Fed all central banks now are keeping short-term interest rates low, at 0 or below 0. And they've continued to say that they'll keep it there. So there's not any pressure on short-term interest rates to rise. There is starting to be quite a bit of pressure on long-term interest rates. And, the Fed has refused to do what is called yield curve control. They discussed it last fall, and they refused to do it. So, in other words, that's a tacit sign that they will allow long-term interest rates to rise, and they have risen since then. So they've risen in other countries too, and the ECB in Europe has come out against further rises in long-term interest rates. The Bank of Japan, of course, is controlling its yield curve. But the Fed's out there saying essentially we're okay with higher long-term interest rates as long as they're a sign of rising inflation expectations and economic growth. And so they're kind of using that as a measure of success, and meaning that a higher long-term interest rate mean higher inflation expectations and mean more economic growth. So they say that's a sign that we've succeeded, and they're letting it go. Obviously, if there's a huge difference between long-term interest rates in Europe and long-term interest rates in the United States, there will be investors that will, currency hedge, their bets and buy, treasuries. So if there's some expenses involved in hedging, but if the expenses, are low enough, that's a profitable, deal you can do. In Germany, you face negative 10-year yields on government bonds still. If you want to do that, you can buy 10-year government bonds in the United States and hedge against the currency risk. And so that means that there will be foreign demand, lots of foreign demand for U.S. Treasury securities if and when the longer-term interest rates rise beyond a certain point. And that will keep a lid on long-term interest rates. So foreign demand will keep will keep a lid on long-term interest rates in the United States. We've seen that, and we continue to see that as long as major European long-term yields are below zero. We're going to see it, and in Japan too. We're going to see a lot of pressure, downward pressure in the United States on long-term yields, even if there's upward pressure within the United States on those yields.
If you had to pick a camp, would it be inflation or deflation, and why?
Yeah, so a little bit of inflation or a little bit of deflation alternating, that would be a good thing. That would be essentially price stability. So if you have 1% inflation one year and then 1% deflation the next year, and then you would have a currency that wouldn't lose its purchasing power. So you have actual price stability. And of course, that's anathema to central banks. I would favor that. So you would have to pay off your debt with dollars that are not weakening. So you would actually have to deal with your debts the proper way. And if you can't, you have to default. And that's okay too. Investors are paid to take those risks. That's what I would do. I would aim for true price stability, which means that occasionally you have a little bit of inflation and occasionally you have a little bit of deflation, which means the purchasing power of the dollar rises in deflation and it declines in inflationary period. I would not want a large case of inflation, and I would not want a large case of deflation. Either way, I think neither one of them is any good. But it's a true price stability. I think it should be the target.
Wolf, thank you so much for chatting with us.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Danielle Park, and Wolf Richter. And thank you for listening. If you have any questions for the show, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to Company Showcase, Larry.
Good to be back, Jim.
Larry, what's the latest news release from American Manganese?
Well, Zarko, our Director and Chief Technical Officer, is presenting at the Benzinga conference on the 22nd, and we're looking forward to that. It's a small cap virtual conference that gives the company a lot of exposure. So you can't complain about that. And I advise everybody we'll have a news release attached to this podcast where you can connect to the Benzinga.com. So just don't miss it, guys.
Larry, I know that your showcase program is very popular. You have a lot of listeners, and you get a lot of emails asking questions about it. So we thought, why not take a look at some of those questions? So this week, our first question we are going to address is, what's the situation with your patents?
Well, we get a lot of questions on the patents, like how long they're good for, they're worth nothing, all kinds of things, because they read the bull boards and the CEO boards. Patents are one of the most important things in a new technology that a company can hold, and so we focused a lot of money and attention on that. Since we've applied and gotten those patents, we have spent roughly about $10 million. By the time we're finished here, it'll be about $12 million. And just to elaborate on that, that'll take us over $20 million on pilot plant work and
feasibility studies, etc., that all relate to the patents. But the patents themselves have a high cost, and like I said in an earlier interview, you don't get the patent out of a cracker box. You know, you have to spend the money and the time and the due diligence on getting that done. R&D is just that. You know, research and development means that you come up with a wise idea, which is Metco's role, and then to prove that idea out, a lot of our R&D is done, and you know, you don't have a formula. You've got to develop the formula, so it just takes time. And what does a patent do for you? Well, if anybody decides to encroach on your technology, you know, sooner or later you will find out that they're doing it. That gives you the opportunity to sue them for the on the patent and to seize the assets that they built. So that could be a plus, and anybody that's operating without patents doesn't have that opportunity that a patent protection does for you. What is how does a patent protect you? Well, you come under U.S. patent law, you come under Korean patent law, you come under European patent law, and you'll find out exactly what a patent does for you. And anybody that pans the fact that we got patents and they're easy to get is just doesn't understand the business. So I'm happy. I'm happy that we got the 2 patents on the recycling. We have 5 patents filed on the manganese, which is a cornerstone of our patents, and you know, and now we've got 3 patents, including Korea. So, or we will have 3 patents very shortly. We've got the approvals. So, what more can I say about that? But patents are the backbone of what you do, and don't ever, you know, dismiss the fact that your patent is not protectable.
Some of your listeners have asked about predatory trading. What's the issue there?
Well, that's an ongoing situation. I've had lots of discussions on predatory trading. Where I see the predators happening now is, you know, in the last, I guess, previous 7 days, 5 of them were down days at 10, 12 cents every day. And they had a formula. They had a computerized cell system, algorithms, and they basically, at the end of the day, would chase the price down. You could, for example, on Wednesday, we traded all day at an average price of $1.30, and we ended up the day at the close at $1.13. You know, on a few tens of thousands of shares. That's the predators. You know, no investor waits till the end of the day, passes up $1.30 just to sell it at $1.13 to $15 at the end of the day. That doesn't make sense. So that's a big tell for you. And so you know, but you're always going to have them in your face, and you know, in the end, they end up helping you to boost your stock. So you know, we got to live with it. It's a fact of law. There's no uptick rule in Canada. There's short rule in Canada, and not being a short rule. Anything else that used to pertain to a short rule, like you couldn't short unless it was on an uptick. Now you can just grab 1 million shares out of the air and just sell them and smash out bids, and that is criminal. And you know, because they're hurting investors, they're hurting the opportunities for jobs, they're hurting all kinds of things that down the road. They're bringing absolutely nothing to the table except into their own pockets. And I know they hate my guts for it, but you know, somebody's got to stand up to them. I don't see many other CEOs ever discussing that. They should. And I find that educating my investors on the tactics of predator trading is the best way to go. That way, they can go into things with their eyes wide open.
Larry, another question that you were asked was, what's happening with you not having signed a major deal yet?
Well, the question is wrong. We have signed a deal with an MOU, with the Italian Gigafactory. And, we know that they're designing the factory right now. We know that they've been contacting us on what we need to be built into that design. And it will be some time before we work out the economics of how do we split the apple. But that's a huge supply. It's you're going to build a 5-ton first plant, and a 5-ton first plant wouldn't handle all of the scraps that they'll eventually have. But we're going to be there for everybody. We're getting lots of calls now on from gigafactories on what our process is all about. We're transparent, and that should work for us because we can sit down and prove our worth on a phone call and a Zoom call, and it just works well to be transparent. I mean, if you're not transparent, maybe you don't have anything to be transparent about.
Larry, what's the company all about for people who are new to this program?
Well, we're a lithium-ion battery recycler. We can recycle anything from cell phone batteries to EVs. We've focused on EVs, although the cell phone batteries have a lot more cobalt in them, and some of the other batteries, the smaller batteries, do, and some of them just lithium manganese, which is not a lot of money, and for power tools, etc. But it's a process that's coming. The whole industry is hundreds of billions of dollars, if not several hundred billions of dollars on the building of battery manufacturing and the EV car industry, and now it's working its way down into the recycling. And I expect to see the recycling picking up over the next few months. News on that will be prevalent, and so that's a very good thing for us because already they're talking in 2025, 15 or $20 billion worth of recycling on batteries, and that tells me that we don't have to be first, but we will get a big part of it because our whole solution is environmental friendly. We put nothing in the air. We put nothing in the back into the environment. Our water is all recyclable. Reuse of water, and people have to go and look at our patents to see that they're cradle-to-grave solutions. And not everybody's going to have those. They're going to be using different techniques of hydrometallurgy. And to be very honest with you, I've been around mills and everything else in the mining for most of my career. So I know that we've put the cap on the best method.
Larry, where are you traded, and how can people get more information about American Manganese?
Well, we're traded on the Toronto Venture Exchange under the symbol AMY, and we're traded in the U.S. on the QB Exchange under the symbol AMYZF, and we're traded in Frankfurt under the symbal 2AM. We're getting a lot of European shareholders these days, and I want to see them make a lot of money, as well as all the other investors, and I just don't see anything but a fantastic future for this company. If you ask me if I'm getting any sleep, I do. Maybe I'm agitated about the tactics with the predators, but I've grown used to that. And but I'm not agitated about how solid our technology is. You can go and find all that information on our website at AmericanManganeseInc.com. You can email me at LREAUGH@AMYMN.com, or you can phone at 778-574-4444.
Larry, thank you so much for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on April 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.